Hello learners, I am Dr. Nidhi Mathur, PhD in Public Administration and teaching at Institute of Management Technology, Center for Distance Learning, Ghaziabad. The subject expert is Dr. Nidhi Mathur, teaching in National Law University, Jodhpur, Rajasthan. In the previous session, we discussed the topic on basics of international investments. Today, we are going to talk about international financial management in detail. The financial market of World Financial Center, where shares, currencies, bonds, debentures, hedge funds, mutual funds and other long-term securities are purchased and sold, is referred to as international capital markets. It is comprised of group of different countries' capital markets associated with each other through internet that facilitates dealing in shares and bonds of different countries for international companies and investors. Almost all financial markets are converted in international capital markets after the evolution of internet and revolution of financial market in 2010. Initially, the international capital market dealt in foreign exchange, where companies have to take certificate, that is Global Depository Receipt or GDR, for dealing in international market, which happened after globalization of financial markets. The daily turnover of international capital market has already crossed the mark of $5 trillion, and since in international market you can buy debentures, mutual funds and shares of companies from different countries, and it is very helpful for reducing the risk of small company. Let us now understand international capital markets. A system in which people, companies and governments with an excess of funds transfer those funds to people, companies and governments having a shortage of funds is basically referred to as international capital markets. For those who wish to borrow or invest money internationally, this transfer mechanism provides an efficient way. If any country is facing loss, your investment in that country may suffer losses due to financial crisis, but you can fulfill this loss from other countries' investment and overall risk will be reduced by this technique, as different countries have different business environment. To access capital markets, there are two ways, that is either equity or debt, where equity is money that is invested in return for a percentage of ownership but is not guaranteed in terms of repayment, and debt is money that is borrowed and must be repaid. However, in general, there are many forms of both equity and debt. Governments, businesses and people can invest portion of their saved income in capital markets such as stocks and bonds, and they can also borrow the savers' investment through the capital markets. With the hopes of receiving a future benefits, savers convert their risk-free assets such as cash or savings into risky assets, and the only reason a saver would put cash at risk is if returns on the investment are greater than returns on holding risk-free assets. Since all investments are risky at some level, in capital marketplace, the financial intermediaries are very important. Banks create economies of scale by lending money to many people, and in this way, capital markets promote economic efficiency, which is one of the primary purposes of the capital markets. In the global sphere, international capital markets work on the same mechanism where the governments, companies and people invest and borrow across national boundaries. Some of the participants in international capital market includes foreign institutional investors, stock exchanges, insurance companies, corporates, financial institutions, hedge and venture capital funds, private equity, provident fund trusts, credit rating agencies, mutual funds, depository participants, public sector undertakings and more. Let us now understand primary and secondary markets. Capital markets are comprised of two major components, primary market and secondary market. The markets where new securities are issued, most commonly stocks and bonds, it is called as primary market. Governments and corporations issues or sells securities to purchasers in the primary markets when they are in the need of funds. The role intermediaries for this issuing process is played by big investment banks. Primary markets are very valuable but less important in comparison to secondary market, as primary markets are limited to issuing new securities only. The secondary market is the place where vast majority of capital transactions takes place. It is comprised of stock exchanges, futures and options, markets, bond markets and more. All secondary markets deal in securities trading, where term securities involves a huge range of financial instruments. The two broad categories of securities includes equity securities and debt securities, where equity refers to the ownership of a part of the company and debt refers to a loan issued to a company or government entity by the investors. Creditors or debt holders receive future income or assets in return for their investment in purchasing debt securities. A bond is the most common example of debt instruments, and all types of organizations can issue bonds. Investors lend their money to the issuers of the bond by buying the bonds, and they receive interest payments generally at a fixed rate for the life of the bond as a return, and also receives the principal back when the bond expires. The most familiar kind of equity security is stocks. Investors can become owners of a share of a company's assets and earnings by buying stocks of that company. The price that investors are willing to pay for its stock will often rise if a company is successful, and then shareholders who bought stock at a lower price stands to make a profit. On the contrary, its stock may decrease in value and shareholders can lose money if a company does not perform well. Both general economic and industry specific market factors plays a role in falls and rises in the price of a company's stock. The issuing entity, a company or government, only receives the cash in the primary market issuance, and it is the key to remember with either debt or equity securities. The security is traded once issued, but the company receives no more financial benefits from that security. In order to have the credibility to borrow funds from or sell more shares in the market, the companies are motivated to maintain the value of their equity securities or to repay their bonds in a timely manner. Major components of the international capital markets. Some major components of international capital market are international equity markets, that is, companies sell their stock in the equity markets, and all the stocks traded outside the issuing company's home country are consisted in international equity markets. To support local and regional operations, many large global companies issues stocks in major markets and seek to take advantage of the global financial centers. In the past decade, the international equity markets have expanded considerably and offers increased options for financing their global operations to global firms. However, the daily value of the global markets keeps changing. The increased growth in the international equity markets depend upon the following key factors. Number 1, the growth of developing markets is a major factor, as when domestic firms of a developing country experience growth, it seeks take advantage of cheaper and more flexible financial markets by expanding into global markets. Number 2, the drive of privatization plays a vital role in the growth of international equity markets, as the general trend in developing and emerging markets in the past 2 decades has been to privatize formerly state-owned enterprises. $1 billion of new equity is infused into local and global markets when the large entities sell some or all of their shares, and these shares are bought by the investors who are eager to participate in the growth of the local economy. Number 3, investment banks often lead the way in the expansion of global equity markets, with the need to simply expand their own businesses and also due to increased opportunities in new emerging markets. Investment banks seeks retention from large companies in developing countries or the governments willing to pursue privatization for issuing and selling the stock to investors outside the local country who has the capacity to buy. Number 4, the advancement of technology is another important contributing factor, as it has opened new opportunities for investors and companies across the globe with the expansion of technology in global finance. More efficient and cheaper means of trading stocks is being facilitated through the rise of technology and internet, which even includes issuing shares by smaller companies in some cases. International bond markets. The most common form of debt instrument are bonds, and it is basically a loan from the holder to the issuer of the bond. All the bonds sold by an issuing company, government or entity outside their home country are comprised in the international bond market. Companies prefer using bonds or debt to raise capital, that is money, if they do not want to issue more equity shares and dilute the ownership interests of existing shareholders. International bond markets are accessed by companies for various reasons, such as expanding its operations in one or more countries or funding a new production facility. Foreign bond: a bond sold by a company, government or entity in another country and issued in the currency of the country in which it is being sold is referred to as foreign bond. With foreign bonds, there are several kinds of risk associated in economic and political terms. These bonds are used by many sophisticated buyers and issuers as complex hedging strategies to reduce the risks. The rules and guidelines for foreign bonds are same as for domestic bonds in the country in which they are issued. Foreign bonds are slightly more expensive bond than the euro bond, as there are also regulatory and reporting requirements, and given the size of the bond issued by the many companies, these requirements add small costs, increasing the overall costs. Euro bond: a bond issued outside the country in whose currency it is denominated is referred to as euro bond. Euro bonds are the most popular form of international bond, and they are not regulated by the governments of the countries in which they are sold. Global bond: a bond that is sold simultaneously in several global financial centers is referred to as a global bond. It is denominated in one currency, that is generally euros or dollars. The company can reduce its issuing costs by offering the bond in several markets at the same time, and this option is generally reserved for typically very large firms that are creditworthy and high rated. Euro currency markets: in 1950s, when communist governments in Eastern Europe became concerned that for political reasons any deposits of their dollars in US banks might be confiscated or blocked by the US government, then it resulted in origination of euro currency markets. These concerns were addressed by communist governments in Eastern Europe by depositing their dollars into European banks, which were willing to maintain dollar accounts for them. The US dollars deposited in European banks created what is known as the euro dollar. Banks in other countries, including Japan and Canada, also began to hold US dollar deposits over the years, and any dollar deposits in a bank outside the United States are referred to as euro dollars now. Here, euro is just a prefix, that is a historic reference to its early days. Euro currency is an extension of the euro dollar, which is a currency on deposit outside its country of issue. Almost half of world deposits are in the form of euro dollars. However, euro currencies can be in any denominations. Another growing part of the euro currency market is the euro loan market, and for large credit-worthy borrowers, including governments and large global firms, it is one of the least costly. The interest rate at which banks in London charge each other for short-term euro currency loans is called LIBOR. In short, and euro loans are quoted on the basis of LIBOR. There are no regulations in the euro currency market, which is the primary appeal of this market, and it results in lower costs. The transaction sizes tends to be large in the euro currency markets as very large global firms, banks, governments and extremely wealthy individuals act as participants in it, providing lower transaction costs overall and an economy of scale. Offshore centers. The world financial centers are the first tier of centers in the world and acts generally as central points for business and finance by being home to major banks and corporations or regional headquarters for global firms. All offshore centers have one globally active stock exchange at least. Some of the major global financial centers include London, New York, Singapore, Sydney, Tokyo, Hong Kong, Chicago, Geneva and Zurich. A group of countries and territories constitutes offshore financial centers in addition to the global financial centers. A country or territory where there are few rules governing the financial sector as a whole and low overall taxes acts as an offshore financial center and often referred to as tax havens. The local government of most of the countries or territories that are an offshore centers has determined being and offshore centers as its main industry and they are also politically and economically stable. To remain globally linked and competitive in the global finance marketplace, they invest in technology and infrastructure. Offshore centers have been increasingly important in the global capital markets due to the size of financial transactions that flows through them. The role of international banks, investment banks, security firms and global financial firms. In the past few decades, the role of international banks, investment banks and security firms have evolved significantly. Many of these institutions have merged to become global financial powerhouses. Their primary purpose has changed in many ways. Traditionally, by servicing the needs of multinational corporations, international banks have extended their domestic role to the global arena. These banks have provided tools to finance exports and imports and offered sophisticated cash management tools including foreign exchange along with receiving deposits and making loans. For an instance, international banks provide services such as electronic funds transfers or wires and foreign exchange transactions etc. to the companies that are in a need of short-term financing for purchasing products from another country. There are different types of banks in broad strokes and on the basis of their activities, they may be divided into several groups. In general, retail banks focus on mass market products such as checking and savings account and mortgages and other loans and credit cards. They deal directly with consumers. On the contrary, private banks deal in providing wealth management services to families and individuals of high net worth. The clients of corporate banks are usually major business entities and services to medium-sized businesses and other organizations is provided by business banks. Lastly, services related to financial markets such as mergers and acquisitions is provided by investment banks and they are primarily focused on helping companies governments and large institutions to achieve their financing objectives by creating and selling securities like debt and equity. Recently, to create global financial powerhouses, these separate institutions have merged or have been acquired by another institution and now have all types of banks under one giant global corporate umbrella where all can operate on global level. Benefits of international capital market. In general, creating economies of scale and promoting economic efficiency stands as main purposes of capital markets, and it denotes ease of buying and selling securities and seamlessly converting it into cash when necessary, along with aiding immobilization of idle savings and channeling it into a direction of more productive investment. They ensure optimal use of resources by balancing the supply and demand of funds, driving financial security that results in development of the economy and capital formation. The borrower seeks to use the borrowed capital to fund a purpose such as a business idea, and the lender attempts to utilize or lend the money more productively, and this shifting of funds is facilitated by capital markets to achieve maximum efficiency of those funds. Now, international capital markets functions in the same way across national boundaries, that is, on a global level by allowing businesses to tap into the foreign markets with a lower borrowing cost and high returns as compared to a domestic capital market, which helps in diversifying risk. Additionally, it also enables the potential of converting an asset into cash while keeping the principal value intact by providing an approach for long-term investment, and due to its liquid market, it provides continuous availability of such funds. International capital markets also provide the benefits in addition to the benefits and purposes of a domestic capital market, such as lower borrowing costs and higher returns, enabling access of new sources of funds to companies and governments by facilitating them to tap into foreign markets. Diversifying and reducing the investment risk by allowing individuals, companies and governments to access more opportunities in different countries to borrow or invest, as it's unlikely for all markets to experience contractions at the same time. Drawbacks of international capital market. There are few shortcomings associated with international capital markets, such as in comparison to domestic market, the cost of capital is more in a global market. The liquidity of investments in a true global market. Speculative flows in the market may drive foreign investments. In a global capital market, the availability of capital is low. Now, let us conclude. International capital markets have revolutionized the process of investing with an efficient mechanism of lending and borrowing funds at international level, where people, companies and governments with more funds lend money to those who have shortage of funds. The evolution of international capital market is the resultant of advancement in technology and internet. There has been an exponential growth in the international equity and bonds in last few decades. International capital market has fueled the growth of developing markets by driving privatization and through the emergence of global financial powerhouses. So, that is all for today. Hope you have understood. We will meet in the next episode with a new topic to take understanding of international financial environment at a deeper level. Till then, take care and goodbye.